Hi, this is Greg. Welcome to the channel. Well, in the last week, we've seen three major banks collapse. Silvergate, which was the smallest one, Signature Bank, which was the next biggest one, and Silicon Valley Bank, which was the largest bank to collapse over the last week. So in this video, we're going to talk about four major areas to help you understand what's going on here. The first one is what actually happened to make these banks collapse. The second area is what is the government doing about it and what was their response to the crisis. The third area is this an isolated event or is it something more systemic? And then the last topic is what does it mean to you as an investor going forward? Okay, so how did all this happen? Each situation is a little bit different, but we're going to talk about what caused these concerns initially and then what caused each bank to collapse. Now, in the case of Silvergate, that is more a crypto-related bank, so we're not really going to talk about that because that's a separate category. Okay, but starting with Silicon Valley Bank, SVB, and also Signature Bank, both of these had similar stories, so let's talk about that right now. So in order to understand how this can happen to a bank, we have to go back to discuss Fed policy. Okay? Now it's no secret, and everyone who watches this channel knows, that the Fed, previous to March of 2021, was embarking on a Fed policy that involved easy money. This involved keeping interest rates at zero and also printing money and manipulating the bond market to keep interest rates low. One of the criticisms of the Fed was that after COVID, when the economy was already recovering, the Fed kept printing money and kept interest rates at zero for far too long, and they got what experts call behind the curve. This was compounded by the fiscal side of the equation, and it equated to approximately $5 trillion of government spending, which was just deficit spending where they were borrowing money and flushing it into the economy. Both of these factors combined caused the economy to overheat, and as a result, inflation skyrocketed. So what happened with this is starting in March of 2021, the Fed started to raise interest rates and drain liquidity from the system, i.e. reduce its balance sheet. When the Fed started doing this, interest rates naturally went up in all areas. We ended up with an inverted yield curve, and as a result of what the Fed was doing, the value of mortgage-backed securities and also Treasury securities went down in value because yields were going up. And when you look at bonds, yield and price vary inversely. When the rate on a bond goes up, the price comes down. So those two things vary inversely. So as a result, when the Fed pumped up interest rates and when the market reacted to it and it stopped buying bonds and the market started to work itself through the system, rates went up and prices came down rather dramatically. So fast forward to today with these banks, a lot of banks, particularly the smaller banks, which have limited access to capital, limited numbers of way that they access capital, they rely on depositors to get most of their money. When the Fed was manipulating the bond market and essentially lowering interest rates, many of these banks, in order to get more yield on their deposits, to make more of a spread and therefore more of a profit, went farther out on the yield curve in their securities purchases and therefore ended up, in the case of Signature Bank and also SVB, ended up with very large, long-dated securities portfolios. Now, this is fine when you don't need the money. You can just keep them on your balance sheet. And also, if you categorize them as held to maturity, you don't have to mark to market on your balance sheet. But the problem arises when depositors suddenly want their money back and you're forced to sell those securities, then the bank takes an enormous loss. So in the case of these banks, when the market and some of their depositors began to sense that there might be a liquidity issue, there was what they call a run on the bank, meaning that many of the depositors want to take their money out all at once, causing a cash squeeze. And this is what happened with SVB. Some notable investors like Peter Thiel recommended in a tweet that depositors take their money out, and this caused a run on the bank. And it was shortly thereafter that the feds took over the bank. Same thing happened with Signature Bank. Signature Bank was more real estate related. SVB was more venture capital related. But similar dynamics occurred when depositors started to take their deposits out, and in both cases there was a run on these banks. So what was the government's response? The government rather quickly came out and said that even the uninsured depositors, meaning the depositors that had more than $250,000 in the accounts, would be covered, and everyone would have access to their accounts within a day or two, and that helped to stem some of the panic. In addition to that, they set up what they call a medium-term lending facility, where if you're a bank, you can take your securities that have declined drastically in value and put them up as collateral to the Fed, and the Fed will give you full face value on those securities in order to borrow against them. That gives the bank more liquidity. Okay, now one of the things that everyone's concerned with, including the stock and bond market, is are these bank failures isolated situations, or is it evidence of a greater systemic risk? Well, the answer is we don't know yet. Okay, at the point in time when I'm making this video, the market is still extremely volatile. There are a lot of things that are coming out on a daily basis, but we still don't know how extensive this regional bank problem is. It appears at this point in time that the money center banks are safe, and in fact, just today, Republic Bank, which was one of the banks that had sold off and appears to be, heading toward insolvency, it was announced today that a consortium of banks, including the large money center banks, have committed to put up to $27 billion into Republic Bank, and this will help invigorate the bank, so to speak, and help it with its liquidity issues. I find this interesting because to me, it strikes me as this is something that obviously the government, the Fed, and the Treasury orchestrated to essentially provide to Republic Bank a private solution to their problem as opposed to another government bailout, because politically it appears that government bailouts to these banks is becoming extremely unpopular. In addition, just today, Janet Yellen, the Treasury Secretary, spoke to Congress and basically stated very emphatically that the banking system is sound, and this gave the market a lot of confidence, as was evidenced by a major stock rally today. This week, CPI came out, or as I call it, CP-lie, came out, and it was basically 6%. We know it's higher, but the really disturbing factor is that for the last 3 months, core CPI has continued to go up. And also, there has been continuing high inflation in the labor sector and also the services sector. So inflation is not going away, and the Fed, from that perspective, has to continue raising interest rates. And the jury's still out as to what they're going to do next week when they announce their policy, and they announce if they're going to raise, 0, 25 basis points or 50 basis points. No one knows at this point. I'm betting that they'll probably back off a little bit from the expected 50 basis points and do 25 to show that they're still committed to fighting inflation, but at the same time not wanting to upset the apple cart, so to speak, in the market. Now, what does this mean to you as an investor? Okay, I'm an investor, you're an investor. We're all concerned with how this affects the macro and the individual stock situation on our various holdings. I have said all along for the last year, ever since the Fed started raising interest rates on this channel, I have been in a defensive posture. I believe that we are and have been in a bear market ever since the Fed started raising interest rates and tightening credit. I have stated on this channel, don't fight the Fed. There's no way that you can have a sustained bull market when the Fed is raising interest rates and tightening credit. I have seen nothing that would indicate to me that there is a reason for the Fed to back off other than this banking situation. And I can't tell at this point what they're going to do, but I can tell you inflation is still here. We are a long way from the 2% target. And one way or another, the Fed's got to combat this in the context of dealing with this banking thing. But I think that we are going to continue to be in a bear market. So what does that mean to you? What I would say is be cautious. These rallies in a bear market sometimes can make you think that everything's changed and it's time to buy. I would not fall for that. There have been several times, including the most recent sell-off, where retail investors have gotten fooled and have jumped in with Tesla and the meme stocks and tech stocks and everything else, only to a few weeks later be disappointed when the market basically goes down significantly again. So my continued advice, as it has been on this channel for some time, is keep a healthy cash cushion, 25%. And, you know, you can look for some long-term opportunities. You can be a stock picker in this market. But for the most part, we're in a bear market and you should be defensive and act accordingly. Well, thanks for watching. I hope you got value out of this. And if you did, please like and subscribe, because I'd love to have you on board for future presentations. And I think the thing to do at this point is check out this playlist where you'll see a lot more content of interest to you on investing and the markets. Thanks again for watching, and I'll see you on the next video.